In this video, we're going to break down exactly how raising interest rates controls inflation so that you can understand what is happening to your money and make smarter financial decisions. Let's get into it. All right, so here is a quick overview of what we'll cover today. First, we're going to look at what inflation and interest rates actually are. Then we'll dive right into the mechanics of how the central bank uses these rates to cool down the economy. Next, we'll explore how this impacts your everyday life, from mortgages to credit cards. And finally, we'll look at the big catch, because raising rates does not just hurt inflation, it can seriously hurt the economy too. The invisible thief and the magic lever, understanding inflation and interest rates. So let's start with the basics. You go to the grocery store and suddenly a carton of eggs costs as much as a fancy cup of coffee. That is inflation. It's the rate at which the general price of goods and services is going up, which means your purchasing power is going down. Basically, your dollar just does not buy as much as it used to. It's incredibly frustrating. On the other side of the ring, we have interest rates. An interest rate is simply the cost of borrowing money. When you take out a loan, the bank charges you a percentage on top of what you borrowed. But here is the secret. Banks also borrow money from each other, and the baseline cost for that borrowing is set by the central bank. In the United States, that is the Fed, which is short for the Federal Reserve. When inflation gets out of control, the Fed steps in and grabs their favorite tool, which is the interest rate lever. And wait until you see how this single lever directly changes the price of the home or car you have been wanting to buy, which we'll get to in just a minute. Pumping the brakes, how higher borrowing costs slow down the economy. Okay, now we get to the core of it. How does tweaking this one number actually stop prices from climbing? It all comes down to supply and demand. When the Fed raises what is called the federal funds rate, which is the target interest rate at which banks borrow and lend their excess reserves to each other overnight, borrowing gets more expensive for the banks. And banks are not going to just eat that cost. Oh no, they pass that right along to you and me. Suddenly, getting a loan for a new car, a house, or expanding a small business becomes a lot more expensive. Because loans cost more, people and businesses borrow less money. Because they borrow less, they spend less. It is basically like when the bartender turns on the bright lights and turns off the music at 2 in the morning. The party slows down real quick. When millions of people stop buying as much stuff, demand drops. And when demand drops, companies cannot keep raising their prices without losing customers. Eventually, prices stabilize, or even come down a bit, and inflation cools off. But what does this mean for your own wallet? Stick around because we're about to look at exactly how this hits your personal bank account. Your wallet in the crosshairs, mortgages, credit cards, and savings. Yeah, the macroeconomy is cool, but let's talk about your money. The most obvious place you will feel this is if you are trying to buy a house. Mortgage rates are heavily influenced by the Fed. A higher interest rate means a higher APR, which stands for annual percentage rate. A jump of just 1 or 2% can literally add hundreds of dollars to your monthly mortgage payment. It is painful, and it prices a lot of regular buyers right out of the market. The same thing happens with your credit cards. Most credit cards have a variable APR. When the Fed raises rates, your credit card company raises your rate, meaning the interest you pay on carrying a balance gets much more expensive overnight. By the way, if you're getting value out of this video, hit like, subscribe, and tap the notification bell to get more valuable content like this. Now, it is not all bad news. There is a flip side here. While borrowers get punished, savers actually get rewarded. When rates go up, the APY, or annual percentage yield, on savings accounts goes up too. This means the money sitting in your high-yield savings account, or CDs, which are certificates of deposit, will finally earn a decent return. So if raising rates fixes inflation and pays savers more, why don't they just raise them to the moon and be done with it? Well, there is a dark side to this strategy that we'll uncover next. The double-edged sword, recession risks and the pain of high rates. Here's the reality that makes everyone so nervous. Raising interest rates is a blunt instrument. It is like trying to perform surgery with a sledgehammer. When borrowing gets too expensive, businesses don't just stop expanding. They start cutting costs, and usually their biggest cost is payroll. This leads to hiring freezes, layoffs, and higher unemployment. It is a massive source of fear for everyday people trying to provide for their families. If the Fed pushes rates too high or keeps them high for too long, spending stops completely and the economy shrinks. When the economy shrinks for 2 consecutive quarters, that is what we call a recession. The ultimate goal of the Federal Reserve is to achieve something called a soft landing. A soft landing is when they manage to raise rates just enough to bring inflation down to a normal level, usually around 2%, without triggering a massive recession and massive job losses. It is an incredibly delicate balancing act, and honestly, the everyday consumer is the one walking the tightrope. To summarize everything we covered today, raising interest rates controls inflation by making it more expensive to borrow money. When loans are expensive, people and businesses spend less. That drop in demand forces prices to stop climbing. For you, this means credit card debt and mortgages become a lot more painful, but your savings accounts might finally earn some real interest. Ultimately, you have to be very careful with taking on bad debt during these times, and you should probably focus on building up an emergency fund. Quick reminder, this video is for educational purposes only and isn't financial advice. Always do your own research or consult a professional for your specific situation. If you want to keep learning, check out this video next. Thanks for watching, and I'll see you in the next video.